Let's now jump into talking about short-term trading using options on futures at night. Okay. We're going to talk about the process, and then we're going to actually put on a trade. We're going to put on a trade that's going to expire tomorrow. We did not put on a trade on Friday during the witching hour because we had to cancel that session, but we will put on a trade this evening after going over the process of what we should look for when we're doing short-term trades. At the Dorian Way, short-term trades are anything from 0 to 14 days. Right? When we're doing stuff that we call the bread and butter, that's usually 30 to 60 days and even longer. Right? We would consider what earning does over a year out is still bread and butter. When you're doing those type of bread and butter trades, you do not want it to turn into a short-term trade. So we usually get out of those trades at or around the 15-day mark, 15 days to expiration, because we don't want to get gamorous and start changing what should be a conservative type of trade into something a little bit more risky. But short-term trades do play an important part in the learning process. It can help accelerate the learning process by having more occurrences. The more trades you do, the better it is for you regarding learning. And if you only did one trade every year, then it's going to take you a significant amount of time to be able to have enough occurrences to be able to have the education and experience you need. Right? If you're going to do something once a month, okay, that's going to be significantly better than once a year, obviously. Right? But if you're going to do something that's say once a week, once every 2 weeks, then that will speed up the learning process. You'll be able to see what happens when things go wrong, because eventually something's going to go wrong and you're going to have to decide, am I going to get out based on a 3 times stop loss, or I'm going to get out based on adjusting, based on what we teach at the Dorian Way of green, yellow, and red zone. Am I going to roll out? Am I going to do a roll away, roll up? What kind of adjustments I'm going to do? If you're going to do an adjustment, then you need to learn that process. If you're going to do a 3 times the credit you receive, so for example, if you receive $100 and then you get out when that trade is trading at 300, so that's 3 times the credit you receive, then you that's fine, right? You can use that philosophy, but you have to have the discipline to do that. You can't be soft on your discipline, or it can short-term trades can turn into a huge problem for your account, especially 0 DTE trades. And what we're talking about right now this evening is going to be a 1 DTE trade, and that's the second most risk to a 0 DTE trade. But those trades can give you a really amazing return on your portfolio, on the capital use, all of that, because it's you do get rewarded for that risk. If the 0 DTE trade, that day trade type of concept, is the most risky, well, the 1 DT is the second most, but you should get rewarded for that, right? You should get rewarded for that.
Please subscribe to our channel. Have fun trading!
So when we are looking at a 1 DTE trade, and we're gonna do this in the ES this evening because this is the S&P 500. It's like doing it in the SPX. The only major difference is that the SPX is $100 per point and the ES is $50 per point. Okay? They both qualify for 1256 contracts. That just means that they get a special tax treatment. It's 60% long-term capital gains rate for short-term trades, anything under 1 year, and then the other is 40%. That's your regular tax rate. So you do get a benefit for trading the SPX and the ES. The SPX is cash settled, so you don't have to worry about being exercised or have to buy shares. Well, that's pretty much the same thing with the ES. You do not have to worry about being assigned anything until expiration. Literally, at expiration, if your option is in the money, then you will be assigned a futures contract, or it's going to be in cash. If it's a quarterly option, it's going to be cash. If it's anything outside of a quarterly option, then it's going to be the futures contract. But you do not have to worry about that unless it expires in the money, and you can always get out of it. Okay? You can always get out of it and not take that futures contract. But it's not like buying 100 shares of the SPX. It's not, or the S&P 500 index. It's not like buying 100 shares of SPY. Excuse me, right? It's not like buying that. If you have to take on the futures contract, maybe you have to have about $7,000 to $10,000 in your account. All depends on what's in your account when you're using span margin. But don't worry about that. Always just get out before expiration, or move the trade to a different expiration. Okay? And you avoid that if you're trading options at night. Right? Anything with a forward slash in front of it is a futures option, and you can trade it at night. All right, so jumping back to this ES, and we go to this 1 DT trade. What we normally want to do with 0 DTE trades and 1 DTE trades is look at what the VIX is indicating to us. What is the actual expected move? Does not mean it's not going to go past that expected move or be significantly less than that expected move. But this is a gauge for us, and 68% of the time it's going to fall within this gauge. So we want to have all the information we can possibly obtain and absorb so that we can make the best trade we possibly can. Okay? It's like, when you are going to do a test in school, you want to know as much as you possibly can about the subject so that you can do well on the test. Okay? And you can pass the test. And it's the same kind of concept when you're trading the zero DT and the one DT. You want to have, or any type of trade, but especially the zero DT and the one DT, you want to have the information, as much information as possible, to be able to make your decision on how you're going to structure your trade. So the first thing we normally do is go and look at this VIX and see what the rule of 16 is, the percentage move of the VIX. So you take that 1383 and you divide it by 16, and that's going to give you 0.86%. So less than 1% is the expected move for tomorrow, right? Less than 1% is the expected move for tomorrow. Can it go double that, triple that, or quadruple that? Absolutely. Or can it barely, move? Absolutely. But this is the range. It's expected to stay within this range. Okay? So we look at that. That's less than 1%. Then we also look at the expected move that the platform that you're on is telling you. And if it's a good platform regarding option trading, it's going to give you an expected move in the right-hand corner of the expiration period. So in this example, this is 1 DTE. So this is the expected move over here. So TastyTrade is telling us 16.54. So let's just round that up and say 17. 17. So what we like to do is double that 17. So 17 times 2, that would take us to 34. Right? That's the 2 times the expected move is 34. So the percentage is 0.86. The expected move, 2 times the expected move is 34. The one time, or the expected move is 17. Then I like to look at the straddle price. Right? I like to look at the straddle price and kind of get engaged what's the difference between the straddle price, which is an expected move that you can use outside of the platform's expected move. That's about 2 points higher than the TastyTrade expected move. So I like to go with the expected move from the straddle, or which one is bigger, right? Usually the TastyTrade expected move is smaller because they believe their formula is better. Their formula is going to be more exact to that 68% of the time. This one right here is going to be, it's more like 72% of the time. It's not really that one standard deviation, it's more. But I want to go with that bigger number. So let's just say we're gonna double that, but we're gonna round up, and we're gonna say 40 points. So 20 and 20. So we're gonna say we want to be 40 points. We want to at least start 40 points away from at the money. This is the at the money line, where the stock is currently trading at, or in this case, the index is currently trading at. It's the at the money. So we want to be 40 points away if we can, right? So 2 times expected move, at least 1.5 times expected move. But we're gonna go with 40 to start with. So on this call side, let's say it's 43. It's 43.10. It looks a little different here because they changed the futures contract. So this is the new active future contract. It's ESUM. What we're looking at here for tomorrow is the /ESM3. So that's this contract is going to expire. You can see the M3 here. I know it's hard to see, but if you can see that, that's saying ESM3. So we're looking at about the 43.09 is the expected move right now, or the at the money line is the 43.09, and so the expected move is based on that. So if we go, let's just say it's 43.10. If we go 40 points up, that's going to be the 43.50. So we'll sell that, and I just look at a 20-point wide here, so we'll go there. And then if we go 40 points from the bottom, we said the 43.10. So 40 points from there will be about the 42.70. I want to sell that, excuse me. And we're going to buy 40 points. Buy 20 points lower right here. So if we did this is going to require about $1,000 in buying power. Your account might say the exact, or a little bit more, or a little bit less. It all depends on what you have in your portfolio. So this is only receiving, in this example here, we're only receiving about, something is off there. We're only receiving about $45. And what I mean by something is off is this extrinsic here. It shouldn't say negative 174. It shouldn't even say 74. It should say 42. This is a max we can make here. So could be some issues going on tonight with the feed from what TastyTrade is getting from the exchange or something like that. And that's giving me some hesitation because of this. These are probably not open yet, but it still shouldn't be these negatives here. But so we're going to look at this $45. That's how much we receive on that. That's not a lot of capital, but let's just see how far we're away percentage wise. So on this call side, what we're going to do is take this 43.50, and then we're going to subtract this number and divide it by this number, because once again, this is the actual futures contract we're dealing with when we're doing this short-term trade here. Okay, so we're going to take the 43.50. All right, so 43.50 minus the 43.10 divided by the 43.10. All right, so this is about just under 1% away on the call side. Okay? Just about 1% away. Let's just say 1% away on the call side. Remember, the expected move is about 0.86%. Okay? So then if we go to this put side, and you can bet that that's pretty much going to be 1% away as well. So if we go to this put side and we say 42.70 minus the 43.10 divided by the 43.10, and that's going to give us basically the 1% away as well. Right? So we're 1% away on both sides. The call side is a 5 delta. The put side is a 7 delta. So the market has been going up quite a bit. You can see the 7 delta here. The market's been going up quite a bit. So if we wanted to collect more premium, it's a few things we can do. First of all, we can decide that we want to do 2 contracts, right? And that would give us, disregard this again, this is something that's off there. This would give us $90. So 45 and 45. So we give us $90 now. Right? But it's going to double the buying power requirement. It's going to be like $2,000 there. We can do that. So if we move that back to 1 contract, we can decide to make the spread wider. So instead of a 20-point wide, we can decide to go something wider. But on this call side, it doesn't really make much sense to go any wider, because you can see that this long leg is basically the same at the 43.75, and then it's all these no bids here, because the market is not expected to jump up that much, even though we are still going up. Right? It's still ridiculous, but I would expect us to be down tomorrow, or fraudulently down. That's basically flat. So I wouldn't adjust that call side to make it wider, because it doesn't make sense to make it any wider. If we look at the put side, and let's say we made that wider, then we can make it a little bit wider, something like here, and that would give us a little bit more, so about $52 before fees and commissions. So nothing great, but still a little bit more. But we can also decide that we'll keep it at 20 points and then move up one of the sides. We decide you're less worried about. So in this case, I would be less worried about the call side, because the market has been going up so much that I would believe that we will have some type of pause tomorrow, or some resistance to the upside tomorrow, perhaps, that you'll be okay. So if we move this up here, and that would give us this, just moving that up a little bit more. So now that's giving us $57, right? $57 for 1 contract. If we decided to move that call side to 11 delta, then that would give us $77 per contract. Keep in mind, this is half the size of the SPX. Like I said, the SPX is $100 per point. The ES is $50 per point. So if you were doing this in the SPX, then this would be $155 that you're receiving. Since it's not the SPX, you're getting about $77. So you can decide to do something just like this, or you can be a little bit more conservative and say, I don't want to be at anything higher than 10 delta, so I'm going to go to this 11 delta here on this call side, keep that 20 points wide, keep this 20 points wide. If you felt like you wanted to kind of give a little bit more bump, you can decide you can skew the trade some if you wanted to, and you can do the put side 2 contracts, but I usually hardly ever do that to initiate a trade. I might do that later on a short-term trade like this to be able to adjust it, but usually going to start with the same amount of contracts on both sides. So if we did this would be about a $57 credit. Is not significant, but it can still be a good return. If you wanted to do 2 contracts, you can definitely do that. Right? So this is the kind of the process that you would initiate the short-term trade at. Okay? So let's look at this, and then let's also look at a 7-day trade, and then we'll come back to this one here, and then we'll execute the trade at the before we are done with the call. All right, so let's move on, and we got about 4 minutes here, so let's put this trade on, and let's see what we can get here with this market at up 6 points. We go to, I'm looking at this 43, I'm looking at this number here, 43.10, and so we were talking about 40 points, so that would be 40. We're not going to go 40 points. That would just be ridiculous on that call side. That's what just something's wrong with it for one day. But anyway, if we go 40 points from there, that would be right here. So this is basically the same area was trading before, everyone. And we didn't do 40 points, right? Or it's gonna be 40 points away and 20 points wide. All right, so this is basically the same trade we were doing. It's literally trading at the same price that it was. So, but we were getting about 45 then. It's going for 42 now, so a little bit has come out. You can argue that, okay, maybe we should bring this call side up some and that would give us 55. And if we wanted to do 2 contracts, we can do that. And this put side is still a 7. That's 40 points away. If we're going to drop, I think we're going to drop on that put side. So just for demonstration purposes here, let's do this here, and let's send this, and let's see if we can get filled. We're going to try to get filled, and we're going to do this in 5 seconds. 1, 2, 3, 4, 5. We didn't get filled. So what we're going to do is cancel this here. Right, so that is this is the trade. We got like 1 minute. It's not that the market's going to close right now, but I wanted to put this on. But they're not going to give us the 15. So what I'm going to do is see if I made it a little wider. Let's see if I made it 30 points. And I guess I wouldn't do the put. Let's see if I did the put side 30 points. Let me see if we went here and did that 30 points. Well, that's only 15 too. So they're robbing us here. Something's off. That why is that 20? I had to just change it. All right, so 20, 10. I want to give a little bit more. That's requiring a little bit more buying power. Let's see what this call side is doing. That's not requiring any more buying power. The call side, I could move this call side up to the 43.40 and say no way we're going up 30 points, and then I can get a little bit more what I wanted.
Don't say no way we're doing that, O'Brien.
I know. So it's high. It's a possibility, right? So I'm going to go with this trade. I'm going to go with, and no only reason I'm going with this trade because if we have to adjust, I feel like we're not going to go up too much more than 30 points. Can we? Absolutely. But that's my assumption, and so I'm going to stay with this high probability trade. I'm more concerned about the put side right now, so I'm not going to move that one. So this is going to be the trade, and we're going to send this, and we're going to get a little bit more than what we were talking about, and I'm going to give it 5 seconds, and then I'm going to move it down to 150. 1, 2, 3, 4, 5, and I use the 5 count everyone so I can be patient and let the trade kind of play out. And so they're going to rob us a little bit, but that's fine. We're going to go and get filled here, hopefully. I thought they would give it to us right away, but that's count. There we go. All right, so we just got filled, and now we're good on that trade. And we collected about, after fees and commissions, about $69. So we're going to try to get about 70 to 80% of that, and we might be able to get all of that 70, 80% by the opening